Hello and welcome to our look ahead at the markets over the next few days. And just to recap, we obviously have seen a bit of a move in the major stock indices, particularly in the US, the S&P 500 breaking out to a fresh year-to-date high and actually ending the longest bear market on an official basis. It's up now 20% off its lows, so ending the longest bear market since 1948. We've also seen movement in yields. We saw the US 10-year up to about 3.8 before pulling back a bit towards the end of the week as US jobless claims jumped to the high since October 2021. So signs perhaps that the labour market is showing signs of cracks. A sustained move above 250,000 initial claims per week would signal a recession is on the cards. That's according to JP Morgan back in April. So we got that. It was up to 261,000. So key questions are facing the market in the coming days. Firstly, bond issuance. So we've got 10-year Treasury auction on Monday. That's going to test the market appetite for US government debt. Remember, after the debt ceiling deal was struck, the market attention has shifted to the amount of issuance that's coming down the line. About $500 billion in June alone for T-bills, and up to about 1.3 trillion perhaps in total by the end of the year for T-bills. And that is going to create pressure in the market. It's going to suck money out of the market. Could see liquidity draining out of the market. But so far, the path of least resistance for the stock market has been to drift higher. That's maybe to do with technical factors. The market being led by sellers of options and low volatility funds, and we've seen volatility compressed, the VIX down to 13, a 13 handle, the market drifting higher. So it's that kind of eye of the storm kind of environment. We think there's risks on either side of these tails, and that's going to be the thing to look out for. I think as Goldman Sachs pointed out, I think S&P 500 at 4390, I think that's when gamma will flip negative, and that could see some acceleration in the move, and it could see a lot more volatility taking place. So eyes ahead for the volatility to increase. Tuesday we get the US CPI numbers. They are interesting, of course, because we've got the Fed on the Wednesday. So CPI seen it, according to the Cleveland Fed nowcast models, 0.19% month over month. The headline 0.45% month over month for core. That would lead to 4.1% annualized year over year for the headline, and 5.3% annualized year over year for core. So core inflation remaining above 5%. Will that affect the Fed? We're not sure. They seem to be hinting at a pause, perhaps, maybe a skip. Maybe they're going to pause now and do one in July. Bank of Canada surprised with an interest rate hike. Was a surprise to some in the market. We always thought it was probably slightly more likely than not. They would be on pause since January, so it gives credence to the idea that the Fed could try to pause with signs that the labour market might just be cracking open just a touch, and they wait to see the lagged effects of these interest rate hikes that have already been pushed through. On Wednesday, it is Fed Day. As I say, it's a case of either another hike. You could get a hawkish hike where they hike and say we're open to do more. A lot will depend on the language that is employed. You could get a dovish hike where they say we're hiking but we're not going to do any more. They could pause and signal we're done. That would be a dovish hold. Or you could have a hawkish hold where they essentially skip. So they say we're pausing for now but we could do some more later. So there's probably about 4 outcomes potentially from the Fed on Wednesday. Looking ahead then on Thursday, it's the European Central Bank. That's a definite 25 basis point hike. Officials have been warning on inflation. Christine Lagarde saying that core inflation, the peak might not be in for core inflation yet. So she's adding to the chorus of hawkish voices that we've got on the ECB, increasingly hawkish. So we think 25 basis points this month, another one in July. The path beyond that, though, is a lot less certain. So we'll see what the ECB says. I think probably they're going to stick with the autopilot button being on. I think they're going to stay on autopilot for now. Maybe some fresh signalling around July. We do have some fresh staff forecasts this month, but unlikely to see any major changes to inflation or growth outlook. And then finally on Friday, Bank of Japan. new governor Ueda, he was signalling to Parliament that inflationary pressures might be pushing higher. Inflation is at a 40-year high. The core inflation is at a 40-year high in Japan, and we saw that Q1 growth number revised up to 2.7% last week, and so that was a big sign that the Japanese economy is emerging from COVID rather well. Private consumption is good, corporate spending is good, earnings are good. Headwinds maybe though ahead with the lagged effects of rate hikes in Europe and the US affecting exports towards the latter half of this year and into next year probably. So the Bank of Japan probably going to hold fire for now. Whether or not they give any signal about normalising policy is unclear, but they're certainly going to stick to yield curve control. I don't think they're going to tweak anything there. But the key will be what new Prime Minister Kishida is saying about wages. Now, last week he was talking about trimming government spending, COVID-era government spending, and then a drive to push up wages. And so if you can see wages really start to climb in Japan, then that could be the trigger for more sustained demand-led inflation, wage price spiral type dynamics, and that would see the Bank of Japan forced to normalise. Question is, has it missed its window? It may have missed the window if the Japanese economy starts to sag in the latter half of the year. That's it for now. Thanks for watching.